Good morning, and thank you for having me here this morning. My name is Adam Rozencwajg, and I make up one half of the investment team at Goehring and Rozencwajg Associates, along with my partner, Lee Goehring. With the time I have today, I'd like to explain our research, which tells us that we are today on the verge of an explosive new commodity cycle, and one that will potentially take commodity prices substantially higher. As many of you know, we are just finishing a severe and protracted bear market that has lasted the last 10 years and has seen commodity prices plummet in everything from copper to oil, and with the exception of gold, which is of course now making new highs, which I'll talk about here in a moment. That in turn has created a massive opportunity and a potential for huge profits going forward. Today we find ourselves at an inflection point for both natural resources and commodity investments. For those willing to listen today, the potential profit going forward could be huge. Both commodities, natural resource investments, and financial assets tend to go through very, very long, sometimes decade-long cycles, and these cycles tend to be inversely correlated with one another. What I'll outline for you today is that there are forces that repeat themselves over and over again in each one of these cycles, and all of those forces that are present that have led to radical under- and overvaluations in the past are present once again today. If an investor is able to recognize these forces and the opportunities that they create in the market, the potential for massive investment returns in the coming decade can be realized. While today may feel very, very different, I'd like to show you that it's no different, in fact, than the commodity cycles that we've gone through in the past, both in the late 1920s, the late 1960s, and again in the 1990s. Each time was a fantastic opportunity for investors to begin switching asset allocations from financial assets into resource and resource-related securities. And today, I think, is no different. I'd like to outline each of the factors in force in these previous cycles and show how they've emerged time and time again and how they're all at work today. Gold is giving us a tip-off about the future for resources and commodity prices, and I'd like to give you some more evidence about other factors at play that I think will reinforce that message. The market is sending a strong signal that the time has come to change positioning in your portfolios, but unfortunately, as often happens, very few investors are listening. Hopefully, I can convince you today that the time has now come to at least be considering that switch. And I think for those that are able to heed the warnings, strong returns are in the future. For those unfamiliar with us and our firm, we are dedicated to natural resource research and investing. We invest predominantly in natural resource equities, and most of our investment decisions are predicated on deep and original research that we pride ourselves on very, very much. Recognizing long-term trends and fundamental factors is at the core of what we do, and we tend to understand and recognize these trends long before other investors, and if anything, at times we can be too early. We often uncover inflection points and trends in markets that signal the end of grinding bear markets and hopefully the tops of extended bull markets. We're deep value investors, and we believe that the best time to find value in the natural resource space is when sentiment is negative, people's allocations are little to none, and the prices of the various commodities are at unsustainably low levels. Here's a profile of my partner and colleague Lee Goehring, made in Forbes magazine back in the summer of 2000. As you'll no doubt recall, gold at that time had been in a 20-year bear market that took the price from $800 an ounce down to $255 as central banks across the world liquidated all of their gold reserves. Indeed, gold was considered an uninvestable asset class, but our research at the time told us that, in fact, gold had never been cheaper relative to financial assets and represented a fantastic opportunity going forward. Indeed, that was the case. Gold did end up being the best performing asset class of the coming decade. And although it's not at 2,500 just yet, it seems to be well on its way. We're proud of our research, and we publish everything that we do on our website. And while I certainly don't have time to go through all of it today, I'd invite anyone with interest to please visit our website and download both our current research as well as our history going back over time. Between Lee and myself, we have 45 years of experience investing and researching in natural resource markets. And I think that we'd like to bring all that experience to bear in our presentation today. The bear market that we're living through and that we believe is ending now has been one of the most severe in resource history. And we've seen many investment firms, both on the buy side and the sell side, shut their entire natural resource divisions. At the same time as all this was happening, we started our new firm in 2016 after having worked together at Chilton for 10 years prior to that. right at the time when most people were shutting theirs. And we find ourselves today, for better or worse, as one of the longest tenured teams working together in the resources space. We've experienced many bull and bear markets in a number of commodities, and we'd like to bring all of this to bear today. If there's one thing I'd like you to come away with, it's that natural resources and commodities go through long, repeatable, and predictable cycles, and they move from periods of radical overvaluation to periods of radical undervaluation. The key for most investors is understanding where we are in the cycle and where the catalysts might be. What I'm going to talk to you about today is a cycle that has now repeated itself 3 distinct times over the last 100 years, and we believe that the 4th cycle is now upon us that will take resources and commodities from radical undervaluation to extreme levels of overvaluation. We're now in periods of radically low prices in most commodities except for gold, but that's about to reverse itself. At the same time, investors have little to no exposure, and if we're right in what we talk about today, rethinking your views on natural resource allocations could be key to your clients' portfolios going forward. We don't think it's an overstatement to say that natural resource investing could be one of the most important investment decisions and themes in the upcoming decade. And I know that sounds unbelievable given how severe the bear market has been, but I'd like to impress upon you why that's the case today. Today's speech is going to be as much about financial history as it will be about supply and demand dynamics. And even though all the cycles we talk about today will have occurred in different eras over the last 100 years, the same forces have always been in effect time and time again that have pushed commodities and natural resource stocks from low levels to very, very high levels and have pushed financial assets in the reverse. All of these factors are in place today, and the investment saga I'll tell you about spans over 100 years and talks about regular booms and busts. They're recognizable forces, and the key, as I mentioned, is in identifying them. The premise of my speech today revolves around a fairly simple intuition. Natural resources are an input into the economy, along with capital and labor, and at the same time, stock market valuations represent a proxy for the value of that economy, and as such, we would expect there to be a relationship between the two. And in fact, there is over time. You may have seen this chart before. This chart represents the price of commodities divided by the price of stocks, in this case, the S&P 500. Typically, when people show this chart, it tends to go back to 1980, and the reason for that is that the most used commodity price index, the Goldman Sachs Commodity Index, starts in 1980. Unfortunately, as we'll talk about here, most of these commodity cycles can last 2 to 3 decades, and so an index that goes back to 1980 is not particularly instructive if we want to look at several different cycles and look at their similarities and differences. What we decided to do was look at the methodology behind the Goldman Sachs Commodity Index and build our own effectively. We had commodity price data going back hundreds of years, and so once we understood the methodology, we were able to recreate an index that closely tracks the GSCI from 1980 till today, and at the same time that we could extend back, in this case, 100 years to 1920. And the results that we've generated, we think, are fascinating. As you can see, the majority of the time, commodities trade in a band between 4 and 5 times the S&P, based on our index here. However, there is distinct and marked periods of radical overvaluation and radical undervaluation. Historically, these have always represented extremely good times to be involved in the commodity markets when they're radically undervalued relative to the S&P, and very, very poor times to avoid resources when they become very, very expensive. Other than today, we've seen 3 periods of radical undervaluation, and each of those, like I said, have been very, very good times to become involved. In fact, following each period of commodity undervaluation, resource and resource stocks have been really the only place for investors to hide and either avoid terrible broad market returns or generate strong outperformance. The key question is, after today's period of undervaluation, are we about to enter a new phase that will propel prices higher? Obviously, this would impact many, many different areas, including asset allocation, inflationary expectation, and sector leadership. Despite how important we think this trend could be, very few, if any, people are talking about it today. But we actually think the investment roadmap of the past 10 years is largely obsolete. The period of weak commodity prices is now over, and higher prices are coming. We believe inflation is on the horizon, and very, very few investors and managers have prepared for that. For resources stocks, this is particularly important because nobody has any exposure to the space. Due to concerns on ESG and environmental issues, indexation and passive investing, which has forced capital into large growth sectors such as technology, and frankly, relatively poor performance over the past decade, investors today maintain a record low exposure to the space. Energy peaked at 30% of the S&P in 1980 and today represents less than 2.5%. Materials, on the other hand, is an additional 1%, so total natural resource exposure in the broad markets is very, very, very low. That leaves investors today extremely vulnerable to a shift away from high-priced technology growth companies and towards resource stocks. Furthermore, active managers today find themselves in desperate need to outperform the passive index. And resources, given how low they are in the index, could be one of those ways if, in fact, performance starts to turn positive. This, in turn, could create a rush into what amounts to a very, very small market cap sector, pushing prices much higher and much faster than in past cycles. If you look at the chart here, clearly commodities are as radically undervalued as they've ever been. In fact, we've broken through the lows made in the 1960s, and we're lower than we were in the late 1990s as well. The key question for investors, though, is whether we'll repeat the huge bull markets that followed the other periods of radical undervaluation. On the other hand, will the FANG stocks and passive index investing underperform going forward? Many investors are quick to point out the difference this cycle. Like I mentioned, ESG investing, as well as electric vehicles, shale production on the supply side, those are all new factors that haven't been present in the past cycles. And while that's all true, the more we look at the market, the more we're amazed at how much each of these cycles actually has in common. Each cycle has a unique set of factors that are not present in any other period in market behavior, and every time they've presented themselves, commodities have gone on to surge. If we're able to identify these factors and position ourselves accordingly, we believe there's a huge potential for outperformance, as well as the ability to avoid stock market collapses. And every single one of these factors is present today. Before I discuss what these common factors are, I'd like to define and go over the periods of radical undervaluation in the past. The first period was in the late 1920s, and this is probably the most interesting period of radical commodity undervaluation. When most people think of 1929, they think of the Great Depression and the stock market crash, but in fact, this also represented the beginning of a relative boom in commodity prices and natural resource investing, as difficult as that may be to believe. Following World War I and the 2021 recession, commodities were left very, very cheap. At the same time, excess credit creation in the latter part of the decade fueled the stock market bubble of 1927 and 28. And by 1929, we found ourselves in a period of extreme undervaluation of resources relative to financial assets. In fact, it was a low that would not be repeated for another 40 years. Again, because of the looming depression, few people talk about the commodity bull market that did occur between 1929 and 1947. And indeed, given how economically sensitive commodities tend to be viewed as, it does seem strange that they should have done well. But instead, resources and commodities did do well. They fared much better than the broad market, and they rebounded considerably faster. Even though you still had the depression and the banking panics lying ahead, between 1929 and 1932, natural resources were only down between 30 and 40%. And that compares with a stock market over that time that was down 90%, and that's why I say only 30%. A decade later, the S&P was still down 50%, while gold and silver were up 70 and 20% respectively. Oil had lost value, but only by 11%, while gold stocks were up a dramatic 700%. Mining stocks, in fact, believe it or not, were up 15%, and oil stocks, even despite the lagging oil price, advanced by 3%. Ironically, the only place to hide during the Great Depression would have been in resource stocks. The second period I'd like to talk about is in the late 1960s, in particular 1968. Just as investors could not become more bearish on commodities and natural resource securities, the 1970s inflationary bull market began. This inflation drove the value of commodities up tenfold, while between 1970 and 1980, the value of natural resource-related stocks rose between 5 and 10-fold. By 1980, the typical cocktail party conversation revolved around gold Krugerrands and hard assets. Stocks merely didn't even manage to double during the decade, and in real terms were dramatically negative. Because of inflation throughout the 1980s, the conventional wisdom said that all of one's investments should be in hard assets, while financial assets should be avoided at all costs. Both stocks and bonds were deemed to be uninvestable, and indeed a 10-year treasury at 16% was to be avoided, dubbed a certificate of confiscation. By 1980, the pendulum had swung completely and commodities had become radically overvalued. Just when people perceived gold to be the only safe asset class, the opposite occurred, and gold prices proceeded to plummet over the next 20 years, while stocks and bonds surged 30-fold in what has been the largest bull market of all time. Between 1980 and 2000, commodities were down while the stock market surged, until the ratio reached a new extreme in 1998 and 1999, with commodities as undervalued as they had ever been. The upcoming commodity bull market that began in 1999 surprised everybody, and certainly after 20 years of massive negative performance, nobody expected gold to be the best performing asset class, as we discussed earlier. Gold, in fact, was rejected by all as a barbarous relic, and central banks sold massive amounts of their reserves between 1980 and 1999. Gold eventually reached $252 an ounce in 1999 and proceeded to surge tenfold, while the S&P 500 was barely flat a decade later. Today, incredibly, we are more undervalued than we were in both 29, 68, and 99. And once again today, few investors believe that resources have the potential to do well over the next decade. Banks are closing their entire resource divisions, and oftentimes investors maintain zero allocation to the space. Will history repeat itself? Are we on the verge today of a massive new bull market? We believe the answer is clearly yes. Investors in those periods, 29, 68, and 99, would all be called crazy if they were bullish on resource and resource-related stocks. But in fact, it was always the right decision, and we think the same is true today, as unlikely as it may seem. As I mentioned, every other period has had a common set of factors before the reversal that took resources from radical undervaluation to radical overvaluation, and all of those are in place today. Unsurprisingly, the first factor that is required in every period of radical commodity undervaluation is a bear market in commodities, and that might sound simple. Over the last 100 years, oil and gas has advanced by 4% per year on average, gold by 5%, and copper by 3%. Corn has been the laggard and only advanced by 2% per year, while the related stocks have all rallied between 6 and 10% on average over the last 100 years. However, leading up to these major inflection points, the behavior of both natural resources, their stocks, and the commodities themselves have been very different. For example, between 1920 and 1929, prices collapsed. Oil went from $3 a barrel to $1.17, a decline of 62%, while gas was similar. Copper, on the other hand, declined by 25%, and corn by 30% to 71 cents a bushel. Gold, of course, was flat because of the gold standard, at least in US dollar terms. In the decade leading up to 1968, corn was down 25%, while copper sold off by 15% and oil by 7%. While it was not as severe as the price collapses in the 1920s, it was still a dramatic departure from the long-term rates of growth. And on a real basis, because of surging inflation, we believe that most commodity prices actually fell in excess of 50%. The huge spike in the 1970s brought on a huge wave of new production, and the Soviet shock in 1989 released excess natural resource materials into the market. Commodity prices utterly collapsed between 1980 and 1998. Precious metals were in fact the worst. Central banks no longer felt that they needed to hold gold, and the selling pressure was intense, taking gold ultimately from $800 an ounce down to $255, or a decline of 70%. Silver fared even worse, falling from $35 an ounce to $4.50, a fall of nearly 90%. Oil peaked in 1990 on fears of the Iraq War at $40 a barrel, and by the end of the decade had fallen back down to 11, a fall of nearly 3/4. And in fact, no commodity was spared during this time. Corn and copper both were down between 50 and 70%. It's actually amazing that this period is so little discussed, given what a material fall in broad input prices really took place. And particularly if you think about how much time is spent about talking about much less severe falls in equity markets, I think that's truly dramatic. The recent bear market has been even more severe, and in fact, when you look at how fast it's happened, that's really what's been so dramatic. Oil peaked at $140 a barrel on concerns over peak oil supply, and this April, of course, as we all now know, turned negative. Even for month end, oil prices finished April at $18.80 a barrel on WTI, a fall of 85%, while gas fell even more, from $14 down to $1.65 in 2015, a fall of 90%. Silver fell from $48 an ounce in 2011 to $14 an ounce in 2015, again a fall of over 70%. and all the various other commodities typically fell in excess of 50%. During bear markets and resources, typically it's low prices that ultimately set the seed for the future bull market. Investors' interest, and more importantly, investors' capital, is dragged elsewhere, and reduced capital budgets result in delayed or deferred new projects. Since all natural resources ultimately deplete themselves, you constantly need a funnel of new projects and new capital to bring on new projects in order to offset the depletion rates. And once capital dries up, projects end up being canceled and the market tightens. The next factor that's been common in every period we look at has been a broad market stock market boom, and in fact, typically a mania in at least one various sectors, not the commodity sector, clearly. Over the last 90 years, the S&P 500 has returned an average of 9%. However, leading up to each period of radical commodity undervaluation and subsequent rally, the market has done much better. Throughout the 1920s, Europe tried to get their currencies back onto gold after World War I. Britain did so in 1925 after deflating its economy by 35%, a massive economic shock. However, gold still wouldn't flow into England, and so Benjamin Strong at the Federal Reserve decided that he needed to cut rates in the US to help promote the flow of gold to Britain and to Europe, despite a relatively strong economy in the US. In speaking to his French counterpart, he described how he would give the stock market a petit coup de whiskey, and indeed the S&P 500 surged over 3 times in the next 4 years, or 30% per year, 3 times the long-run average. In this period, the mania was not necessarily confined to one sector, but rather was experienced by all stocks. In the 1960s, we had the go-go years. This enjoyed a strong bull market, as well as several more typical investment manias or crazes that we might identify today. First, you had the gunslinger mutual fund craze earlier in the decade. This was the rise of professional asset management. Next, you had the growth stock boom and the conglomerate boom, driven by M&A from high PE companies acquiring low PE companies. This, in turn, would generate the growth on an earnings per share basis, which would help justify the multiples and keep the cycle going. Perhaps most famous of all was the Nifty 50, that is 50 stocks trading with PE ratios of 50% or more. The conventional wisdom at that time held that you could just own these stocks forever and enjoyed an almost guaranteed outperformance. Indeed, the S&P increased by 4 times over the decade, or 13% per annum. However, subsectors, including notably the Nifty 50, were up in excess of 30% per year. After a slow start to the 1990s, investors turned very positive on stocks. The S&P rallied 5-fold, or 18% per year, over the entire decade, a very strong performance, with very few drawdowns at all, aside from the Asian currency crisis later in the decade, as well as the Russian ruble and the long-term capital management collapse. There was a mania again as investors and day traders first entered the market, and this time it centered around technology stocks. Between 1995 and 1999, the NASDAQ boomed by over 40% compounded every year. And in every case, both in 29, 69, and 99, commodity stocks were left behind. This in turn set up the supply response I talked about in the years to come and the further bull market that was about to begin. There was always a feeling in these periods that natural resource stocks represented the old economy and that prosperity lied in the future and in the new crazes and new technologies of the day. I mentioned in the 1920s all stocks did well, but the best performing stock was RCA, and it outperformed on the basis of its new technology of the day, the commercialization of radio. In the 1960s, the common wisdom said that conglomerates and high PE stocks should be bought and held forever. You could generate earnings growth out of thin air. Financial engineering took the place of petroleum engineering and mining engineering. The 1990s, as I said, technology was the holy grail. Earnings didn't matter at all as long as website traffic was up. The concern about making money later was pushed out to another day. Today, the market is undergoing 2 distinct investment crazes. The first is a redux of the technological craze in the late 1990s in the form of the FANG stocks. The second, of course, is the passive index trend, which dictates that investors should simply own stocks based on their market cap with no active management whatsoever. This will, in fact, guarantee strong returns over time. Value investing and stock picking has underperformed, and capital has gone out of active management and into index funds, pushing the trend higher. In that way, it feels very similar to the 1960s. Instead of the Nifty 50, the wisdom of the day says to just buy the broad market and add a little bit of exposure to the FANG stocks. Hold this allocation forever, and the rest is fairly automatic. Just as in the 1960s, we believe that the results will be equally as dangerous. So far, we've shown that each period of radical commodity undervaluation that has preceded a massive rally has had a bear market in resources, a stock market boom that has been guaranteed to deliver strong returns in perpetuity. In each time, the investment craze focused outside of the resource sector, and resources and commodities were viewed as passé and were typically sold to help fund the craze of the day. And in each case, the conventional wisdom was wrong. The third factor that I'll discuss is credit, which has also played a very important role in the past cycles. Before each period of radical commodity valuation, we've experienced a very accommodating credit cycle. This has helped to push manias and crazes further than they would have otherwise. It has extended the commodity undervaluation from moderate to extreme. After World War I, the United States maintained the majority of the world's gold supply. Europe, as I mentioned, had suspended the gold standard in World War I and tried desperately to get back on throughout the 1920s at their old pre-war rates. With all the gold in the United States, it was very difficult to do so, and Britain had to deflate its economy by nearly a third in order to try and do so, which incurred a massive economic malaise. As I mentioned, Benjamin Strong realized that he needed to cut rates in the US in order to help gold flow back to Europe, and he did so with the background of a very strong economy and a nascent stock market boom. This created a credit bubble and a stock market bubble that pushed the commodity undervaluation much farther than it would have otherwise. In the 1960s, the US was pursuing its guns and butter policy, and that is a simultaneous effort in the Vietnam War as well as massive spending domestically on social programs. The deficit in the US exploded, and by 1966, global investors worried that the United States might actually break its 40% gold backing. With the economy heating up and gold flowing out of the United States, any sensible central banker would have looked to raise rates, but instead, President Johnson told Fed Chairman Martin to cut rates from 6% to 4% in 1967 ahead of the elections. This helped to inflate another credit bubble and a stock market boom that also went much farther than it would have otherwise. Adding to the conditions, the United Kingdom devalued the pound in 1967, easing credit further. The 1990s was, of course, the time of the Greenspan put. Alan Greenspan cut rates in response to the savings and loan crisis early in the 1990s, the Asian currency crisis in 97-98, the ruble collapse in 98, and long-term capital management. Perhaps the strangest in retrospect period of credit easing during the cycle occurred with a stock market boom in anticipation of the perceived threat of Y2K, when all of the computer clock systems would ultimately crash, and the answer to that was clearly more credit. Over the last decade, we've had very, very accommodative credit policies as well on a global basis following the global financial crisis. Every major economy around the world has pursued a zero interest rate policy. After the Fed had grown its balance sheet by 3% per year over the last century, it doubled it following the GFC and then doubled it again. The response to COVID has been even more extreme. The US has doubled its balance sheet, nearly doubled its balance sheet in a period of only 6 weeks, and the ECB, the Bank of England, and even the Swiss National Bank are following suits to various degree. The fact that $15 trillion of sovereign debt now trades with negative yields is a testament to really how accommodative the credit cycle has become. And we have M2 growing at the fastest rate in peacetime history. We also noticed that the periods ending in 1929, 68, and 99 each saw surging margin loans for stock purchases. This clearly shows how stock values were pushed up even higher than they would have normally, and is a testament to the easy credit conditions of the day. All periods of radical commodity undervaluation were also periods of periods where the financial system boomed. In the 1920s, there was the proliferation of bank accounts throughout most of the United States, while in the 1960s, it was the first time that you had professional asset management to the extent we see today. In 1990s, we experienced a massive brokerage boom as many investors started day trading for the first time. And clearly in the recent decade, we've seen a surge in structured credit and finance on a global basis. We believe that a boom in the financial system has been a necessary factor in every period of radical commodity undervaluation and financial asset overvaluation, which leads to these extremes, and today we have that condition in place once again. Inspired by the work of Russell Napier at the University of Edinburgh, we also noticed that all the periods in question have an unusual similarity. They all were periods of high real and nominal growth combined with periods of relatively benign inflation. Now, classical macroeconomics suggests that strong growth is associated with inflation, and weak growth is associated with deflation. The Phillips curve, of course, formalizes this trend, saying that unemployment moves in an opposite direction as inflation. And looking back over 100 years, there have only been 4 periods where this relationship did not hold. And as you might anticipate, those 4 periods are the ones in question today: the late 1920s, the 1960s, the late 1990s, and the last 10 years. Why is this important? When you have strong growth and no cost pressure like you did in those periods, it tends to be good for commodities that carry few fixed assets. These companies can enjoy substantial growth without tying up capital, and they don't have to deal with rising cost pressures. I would ask you all to think about whether you'd prefer to own Uber or a taxi fleet. And to me, that's the quintessential asset-light versus asset-heavy question. As long as GDP is growing and inflation is low, it's indeed much better to not have to worry about owning the fleet and the garage and maintenance. However, asset-light investing is not always the preferred option. When top-line growth is hard to find and inflation is running high, it becomes difficult to pass along the costs to the end user. In this case, the only thing that can save you is owning the asset itself, whose value goes up and is lifted by the underlying inflation and can help the company keep pace. Indeed, asset-light and asset-heavy sectors fall in and out of favor over long cycles that repeat themselves as well. And these cycles line up nearly perfectly with the periods we're talking about. In the 1920s, the best sectors were asset-light and all high margin. These included the specialty chemicals industry, the electronics industry, and business consulting. The worst industries were mining, steelworks, and manufacturing. By the late 1960s, the best companies were restaurants, high-tech medical equipment, leisure, computer hardware, and software, all typical asset-light businesses. The worst, again, were auto, steel, transportation, and shipping. The 1990s was clearly dominated by a bull market in computer technology, financial services, microchip makers, banks, and telecoms, while again, the worst industries were mining, textiles, and steel. And since 2010, the best industries once again have been microchip, software, lab equipment, and business services. Again, all asset-light. Asset-heavy industries have lagged. If history is to be a guide, we think that a massive sector rotation is about to take place and that this will not continue into the coming decade. Back to the chart, we believe that clearly commodities and real assets are in a bear market. They're as cheap as they've ever been relative to financial assets. And thus far in my talk, I hope that you'll agree that while today's cycle might seem unique, it's actually just a repetition of previous cycles in place after every commodity bear market and immediately preceding every commodity boom. In other periods, no one believed that real assets would ever be better and outperform, but in fact, they were the only way to protect a client's wealth. The key was in identifying the factors, seeing where you are in the cycle, and today is no different. People treat energy as uninvestable, and allocations come close to zero. But this is no different than gold was in 1999, when it was considered to be a barbarous relic and completely uninvestable before going on a bull market that saw the price rise nearly tenfold. We're here again, but no one is heeding the warning, just like they didn't in the past. The next question you have to ask yourself is what will serve as the catalyst, triggering a shift from the bear market to a new bull market? As you can see, in the 1960s, resources stayed cheap for quite a while, and in this business, early is the same as being wrong. This chart shows us how cheap commodities are relative to the broad market, but it doesn't say when to look for the turn. Luckily, again, we can turn to history, and this time we're going to look exclusively at what the catalysts were at the end of every bear market. What broke the psychology in past cycles, and are there any similarities to today? A keen student of financial history might notice a pattern between 1929, 68, and 99. They all have something in common. In fact, these are all years where the global monetary system collapsed and was ultimately changed. The reasons for a breakdown in the global monetary system are, by their nature, extremely complex, but they relate to the factors we've discussed so far: credit creation, asset price valuations, sector leaderships, and manias, as well as the size of the financial system in general. When pushed to the extreme, imbalances begin to emerge. This can trigger a feedback loop that feeds on itself and grows until it collapses under its own weight. When most people think of the late 1920s, they think of the Depression. But it was also the end of the classical gold standard that had been in place for 100 years. From the Napoleonic Wars to World War I, every major economy in the world was either on a strict gold or polymetallic standard. In 1914, all major economies suspended their convertibility into gold in order to help fund the war effort. But once the war was over, most economies tried to go back on to gold. Between 1924 and 1926, Germany, Britain, and France all went back on at various rates. And this had massive economic dislocations. As I talked about before, gold was trapped in the US, and the Fed had to cut rates, as we discussed, leading to the credit bubble and the stock boom. By 1928, the central orchestrator of this plan, Benjamin Strong, died. And as a result, all of his successors who opposed his policies dramatically restricted credit. This resulted, on the one hand, in the Depression, but also in the end of any hope of maintaining the gold standard. In fact, in 1928 also marked the exact low point in commodities and real assets relative to the financial assets, and the exact moment they started massively outperforming. After World War II, all prices of all currencies, all major currencies anyway, were linked together by the Bretton Woods exchange system. This linked every currency to the US dollar, which in turn was convertible into gold at $35 an ounce. This system was in place from the end of World War II over the next 25 years. But as we discussed in the 1960s, the guns and butter policy of the United States was drastically hurting the finances of the country. Concerns over the financial health of the US saw many foreign participants rushing to convert their dollars into gold. By 1967, the dollar was only backed by 42 cents of gold, perilously close to the 40-cent statutory limit. Most people think of 1971 as the Nixon shock, which was when when President Nixon removed the US dollar convertibility into gold, but few people talk about the events of 1968 and 69. And in fact, it was President Johnson who suspended the legal requirement that the dollar be backed by gold in 1968. This caused the London gold market to suspend operations for 2 weeks, and the London Gold Pool, which was set up in 1960 to defend the $35 per ounce gold price, ultimately fell. Incidentally, it was at that moment that the Zurich Gold Pool was formed to take its place, and when Zurich was really cemented as a gold bullion trading center in the latter part of the 20th century. While the US officially suspended convertibility in 71, Bretton Woods ceased to function, practically speaking, in 68. Again, exactly at the same moment that commodities and natural resource investments bottomed relative to financial assets and began their massive bull move. This, in fact, took gold from $35 an ounce to $800, and from oil from $3 to $26. Now, even a top student might miss the shock of the 1990s because it's far less recognizable, but equally as important. It involves the emerging markets. After 1971, major economies freely floated their exchange rates, but the emerging market economies tend to favor a peg to the dollar to promote stability in domestic prices. This worked for 25 years until investor interest in the emerging markets surged. The US maintained low interest rates throughout the 1990s, and the emerging markets attracted hot money as a result. The economies grew by 10% per annum or more and attracted even more money. Once conditions shifted, money began to flow out, and most of these economies were unable to defend their currency peg. In 97, the system collapsed, started first by the Thai baht, and then the Indonesian rupiah. Philippines, Malaysia, and South Korea all saw their currencies collapse between 35 and 80%. By 1999, the crisis was over, and the IMF had stabilized the region. Most countries then moved to a managed float, which really involved their currencies being undervalued relative to the US dollar in order to promote exports. Even though this might be less obvious than other major financial system shifts, it's no less important. Trillions of dollars in global capital flows changed quickly and resulted in a massive buildup of treasuries in China and Asia. Again, it corresponds exactly to when commodities and real assets bottomed and then started their boom. This speech was originally intended to be delivered in April, and since then, clearly the world has changed. Instead of trying to speculate on the end of the current financial system and monetary system, we believe that change is now upon us. We're living through a moment in history. It's happening right today. Massive shifts in global monetary orders, both in the United States and Europe, have been the result of COVID-19. And we believe that the system that has been in place for the last several decades, which has seen the US dollar as the reserve currency, is now ending. Since COVID-19, the Federal Reserve has seen its balance sheet surge from $4 to $7 trillion, and M2, or broad money, is now growing by 26% for the first time since the 1970s. This is the highest rate on record in peacetime and the highest rate in the last 70 years. Modern monetary theory, which involves the direct monetization of US debt, is now taking place, with 100% of the deficit thus far being monetized by the Fed, something that was unthinkable even a year ago. The Bank of England is doing the same, and whether we admit it or not, both the Fed and the Bank of Japan are controlling the yield curve, and we believe the ECB is not far behind. European fiscal unity, which was once thought to be impossible, is now a reality. While we can't say what will take its place, we believe that the shift in the global monetary order today is the most dramatic since the collapse of Bretton Woods in the late 1960s. And so not only are all factors in place to promote a huge commodity bull market, but we believe the catalyst is now here as well. This was not true even a few months ago. Gold prices are clearly telling you that something is happening. Commodities have underperformed for the better part of a decade and are now emerging from their slumber. If history is any guide, we believe that we're in a period of massive outperformance that will last for several years to come. In the interest of time, I can't go into the fundamentals today, but if you're interested, I would highly recommend that you please look at our quarterly letters, which are all available on our website. We write prolifically. We put out 4 letters a year, each at 40 pages, and it goes into extreme depth about all of the supply and demand fundamentals in the various markets. As a very brief summary, the lack of capital in the space has had a huge impact. Pre-COVID, gold production had already peaked. Shale production was peaking, and so was gas production. And now, because of COVID, we're curtailing actively the amount of oil being produced in the world by up to 15%. Drilling for new wells is down nearly 80%. Large-scale mining operations have been curtailed and new projects shelved. This has always laid the groundwork for massive bull markets and resource-related equities in the past, and this time is no different. At the same time, demand didn't fall nearly as much as expected during COVID, as data is now being released and is rebounding faster, led mostly by emerging markets. We think, in fact, commodity demand today is at a very unique moment in history that will not be repeated. We have 4 billion people in various emerging markets going through a period of intense commodity demand growth. And again, we write about all this in our letters, and I'd invite people with interest to go see it. Commodities go through long cycles, and today we are at the bottom of one of the most extreme in history. While it seems radically different, in fact, it is very similar to other commodity cycles. And just when people felt that resources were uninvestable in the past, immediately before massive bull markets, this time is no different. Factors repeat themselves time and time again, and all of those factors are in place today. Catalysts historically have been a shift in the monetary system. And while it might have been audacious a year ago to say that the US dollar risks no longer being the reserve currency, I think that's now upon us as well. No investor has any exposure to this sector, and if history is a guide, it will be the only way to generate outperformance as the decade progresses. The next great commodity bull market is now upon us, whether investors realize it or not. Gold is telling you so, and the other commodities will quickly follow suit. Investors who have become used to mild deflation and low input costs and ample growth are now about to go through a very different period. That roadmap is obsolete, and a new period of inflationary pressure lies ahead. Even a small allocation can help to fulfill the role to diversifying and maintaining value. How you're positioned today can make all the difference going forward, but unfortunately, no one is heeding the warnings. What you recognize in these factors today will be critical to your clients' wealth in the next decade to come. Thank you very much, and I'd like to open the floor to any questions.
Thank you so much, Adam. Well, maybe the first question, let's just assume you're right? Commodities or commodity-related stocks? What's the better way to do?
Well, in the past cycle, it's been better to own commodity-related stocks, and there's a few reasons for that. First of all, there's fixed costs embedded in those businesses, so if the commodity price rises, the earnings of commodity-related securities tend to rise a multiple of that. At the same time, today, natural resource equity valuations are extremely low, and so there's the argument that a catch-up trade, even on low commodity prices, can help to drive value there. And lastly, particularly as it relates to energy, not so much to gold, it becomes very difficult to invest in the commodity because you have a huge contango in the market. Futures prices are higher. And so if you look historically at commodity tracking investments, whether it be the USO or other vehicles like that, they drastically underperform, particularly in a bull market.
With oil stocks, for example, you mentioned ESG and you kind of put it aside a little bit. Isn't that a real threat that your theory is not going to be holding up?
So I think that ESG has been a major consideration in energy stocks to date. And in fact, we talked about energy representing 30% of the S&P in 1980, but it represented 15 and 16% of the S&P much more recently than that. And today it's down to 2%. I think a big part of that has been liquidation from institutional investors from the ESG movement. And so it has played a very big role. I think that a lot of that liquidation, from the conversations I have, is mostly behind us now. And the question is how those institutions will begin to respond if commodity and commodity-related investments begin outperforming. Because it's been a sort of interesting and somewhat easy trade thus far. You can be ESG compliant, and it's also been good for performance. The question is, what do you do when ESG compliance and fiduciary responsibilities run against each other? And my gut feel is that what will end up happening is maybe a rethinking of ESG, perhaps the idea that energy consumers, downstream are penalized to some degree instead of just the producers, something that would allow an allocation to an outperforming asset class, but also remain nominally ESG compliant.
And last from myself, and I'm opening up for a quick round in the audience as well. Any favorite amongst the commodities?
So I think as of today, gold is obviously doing very, very well, but as of today, the most radically undervalued commodity is energy. What we saw in the last 6 months due to coronavirus was really astonishing. Obviously, negative oil prices was dramatic, but what we're seeing on the supply side is not sustainable going forward. When I look at gold relative to any financial asset, it's very, very cheap. And ultimately, we think that gold will finish this cycle at several $1,000s, even $10,000+ an ounce. But as of right now, the ratio of oil to gold shows that oil is as cheap as it's ever been. And so we favor oil and oil-related investments, which are obviously incredibly out of favor. But that's what we like to do, be involved with things that are out of favor.
Okay. Anyone in the audience? Back the last row.
Thank you very much. Obviously, gold is a very special resource, but looking at all the other resources, recalling Alan Greenspan in his book, one of his books he wrote, the most important economic factor he was always looking at when he was in his bathtub, was productivity gains. And if you actually look at productivity gains, it seems to be an enemy to the resources sector. Why? Because for the last 20 years, China's economy has grown for about 6-7% per year. Behind India's economy, we're talking nearly 3 billion consumers. So from a demand perspective, resources couldn't have had it better, right? And anybody here who has been to China is unbelievable, the resources they have been, consuming. And yet, resource prices, I'm not talking of gold here, haven't really taken off. Actually, they have collapsed. And if you look at today, the world, because of productivity gains, can produce maybe not masks, but pretty much anything else rather quickly, which is enormously bad for actually resource prices, because whenever there's a spike, immediately huge supply comes in the market and actually prices, collapse. So how can you be sure that actually prices, will recover? Because the last 20 years they have not.
Sure. So I think it's a great question, and I think, the clearest example of a new technology and productivity enhancement in the last 10 years that has hurt the commodity prices has obviously been in oil with the unlocking of the shales in the United States. In fact, though, while this was a new technology and it resulted in a massive one-time increase in oil production, not dissimilar to the advent of SXEW technology in gold and copper in the mid-1990s, which depressed those from a supply side as well, we now are seeing that cycle also playing its natural course. And so we've seen 3 major developments of shale fields in the US, the Eagle Ford, the Bakken, and the Permian. Those would have been not possible 20 years ago. However, we're starting to see productivity declines in all 3 of those basins. And this started before COVID. This started in 2019. So I think the perception from the commodity space in particular that technology has increased productivity has actually been mostly the result of the shales. It's been widely misunderstood, frankly, because if you look over the last 10 years, while the shales have grown, the rest of the non-OPEC world has actually fallen off, such that OPEC has increased production by 3 million barrels a day over the last decade to help meet demand. So we're not really pushing out OPEC supply the way people sort of think we are, but nevertheless, there's a sort of view that oil is no longer scarce because of technology. That actually hasn't been repeated in many other commodity markets. Copper, for instance, we're struggling despite a decade of relatively robust copper prices, which now have fallen off a little bit, but from 2000 all the way to 2010, copper prices did quite well. That didn't bring on any new supply whatsoever, very, very little. Gold as well, gold mining supply around the world is beginning to roll over, despite the fact that we've been looking for gold for forever. So productivity is very different commodity by commodity. I think oil has been the example where you've seen the biggest shift in productivity over the last 10 or 15 years, but we believe that that's actually now coming to an end as well as that asset depletes.
Another one from the audience? Just in the very front, second row to the right.
What is your take on crypto? Because there is now wide discussion that the young folks, they prefer crypto as compared to precious metals.
Yep. I think cryptocurrency, we're not a fan ultimately of cryptocurrencies, and there's several reasons for that. One notable reason is that while Bitcoin, by its design, is ultimately limited in its supply, and that's sort of the appeal of it, there's really nothing keeping other cryptocurrencies from being forked and started. And in fact, we saw that in the last several years as cryptocurrencies have gained in popularity. So that's one thing where I think, unlike gold, for instance, where really the only thing that you can do in gold is to try to allow silver to be a polymetallic precious metal standard, but you can't, fork and start new precious metals in the same way as you can, clearly, the cryptocurrencies. I think that's going to be a big differentiator going forward. I think, however, the other big differentiator is really, and this might get a little esoteric, but we like to ask ourselves, is a technology efficient at doing the task at hand? And in this case, the task at hand is a store of value outside of the financial system. Now, when you look at the amount of energy that's required for cryptocurrency mining, which effectively is what backs the entire system, it's hugely energy intensive. And you see more power than the entire country of Ireland being put towards crypto, even though it's a very, very small factor in global financial markets. Were it to grow, ironically, its energy intensity has to grow proportionally because the mathematical equations it needs to solve grow in complexity as well. So actually, as far as energy committed and dollars committed, it's much more efficient to mine low-grade gold deposits around the world in order to create a store of value. And so time and time again, you see new technologies unable to supplant old technologies if they're less efficient at doing the task at hand, even if they might be on some levels better. A good example of that might be the Concorde, for instance. Clearly a superior technology, cut down the travel time cross-Atlantic to barely 3 hours, yet was 9 times as energy intensive as a Boeing 747. So it's subsisted for a while. It went through periods of boom, particularly amongst asset inflationary times and things like that, but ultimately couldn't withstand the pressures of that energy efficiency. And I think cryptocurrency ultimately will suffer from that same fate as well.
Well, if you have one quick one, we can take it. Looking around the room. If not, Adam, I think that was wonderful. Thank you very much.
Thank you very much for having me.
Yeah,
Thank
thanks.
you.